Good morning and welcome to Financial Accounting. Today is, I think, day 16, maybe, something like that. We're just about halfway in the semester. If this is day 16, then this is the first day of the second half of the semester. Your second exam, excuse me, was due this past Sunday, and then we didn't have class on Tuesday because of the October break. So you should be able, anytime starting tomorrow, if you haven't already, you'll be able to review your exam in CNow. You can see all the questions, all of your answers, and the correct answers if you did not get an answer correct. If you have questions on that, you should absolutely ask for help. I'd be happy to go over any of that, but we do not generally go over them in class and definitely not on the recording. So I'm happy to help you, but you just need to let me know. Today, we will be finishing up chapter 7. We'll be picking up with exercise 6 in just a minute or two here. So you should have your CNow exercises open to chapter 7. Give me one moment. Okay, I'm back. So we'll be finishing up chapter 7. So the chapter 7 exercises should be submitted for grading by the end of the day today. We will have completed or at least talked about each one of them in class, either last week or today. And then that means that the chapter 7 problem will be due our next class day, which is October 18th, next Tuesday. And we'll be starting chapter 8 at that point. So the chapter 8 pre-quiz will also be due on that day. One thing I wanted to point out to you, and I'll include this in the announcement later today as well. You'll notice that there is a new module on the content table of contents and on the course home. That new module somewhere here. There it is called Zoom Link for Class. That Zoom Link has been set up from the beginning of the semester. That's what I've been using to record class. I wanted to make that Zoom link available because I've already had a couple students who needed to use it for very legitimate variety of reasons. However, this is not a Zoom class. It is not listed as a flex class. You are not expected to use that Zoom link unless there's some legitimate reason that you can't join us on campus in the classroom. You don't need my permission to use the Zoom link, but if it gets to the point where it seems like you're abusing it, that is, you're on Zoom more than you're in the classroom, you haven't talked to me about any extenuating circumstances, you don't have to share personal information with me. You don't need permission to use the Zoom link, but it should be a rare occurrence when that's the only way you can attend class. So I'd rather have you attend on Zoom than miss class altogether, but you shouldn't be using the Zoom option as an excuse not to come to class. So hopefully that's clear. I don't want to have to restrict its use. I want it to be available for people when they need it, regardless of what that reason is, but it should be a rare occurrence. And if it becomes more of a frequent occurrence, you should be talking to me to at least let me know, hey, there's something going on. Maybe you live off campus, you don't have reliable transportation. Maybe you live at a distance, and I hope not, but maybe the weather becomes unsafe. And as I said at the very beginning of the semester, because I'm driving 50 something miles to get here from my home, if the weather does become an issue, we will likely just have class on Zoom. You guys who live here, if you find on campus in particular, at that point, if you find it easier to still be in the classroom, you can do that. I will put an announcement on Zoom, or excuse me, on Brightspace first thing in the morning. So that announcement would be posted by 7:30 or so. And as far as I know, you guys are still getting those announcements in your email. So you would have plenty of notice if I'm not physically going to be here present on campus myself. But that's that Zoom link that's now publicly available here in the modules is the link that we would use, the link that you would use if you can't be in class. And it's the link that we will all use if there's a day that I can't be here. Questions about that? Welcome to use it, but please do not abuse that. It is a privilege. You're not registered for a Zoom class. So, all right. Last class, we spent most of the time with me talking about the internal controls piece of chapter 7. Unfortunately, there's not a lot of what I call the doing of accounting in that portion of the chapter, so it's much more of a lecture-based class than what we typically have, and it's not what I would prefer, but I do believe that the information that we discussed last class is really important for your understanding of how the accounting profession got to where we are now, because it is very different than it was 20 years ago. The accounting rules are not affected by that, as far as debits and credits and the fundamental accounting equation. That's all, that was established 500 something years ago, but the governing principles for the profession have changed dramatically in the last 20 years. The good news is we have that part of this chapter behind us, and so our focus for today in the exercises we have remaining will all be on the actual doing of accounting, and we're really shifting to the other part of the chapter. So the title of the chapter is Cash and Internal Controls, or something to that effect. And we are going to be focusing on the cash piece of that starting now. Before we do that, does anyone have any questions, anything you want to talk about from the internal controls part of the chapter that we covered last week? Okay. I don't know that it would make a difference to you guys, but just so you know, there's also a likelihood that we'll have one or a couple of students from the asynchronous online section of this course start joining us, maybe on campus or maybe on Zoom. So if you see a new face in the classroom, you'll know that that's someone who's been taking the class in the asynchronous world and maybe is now able to attend physically here with us on campus. So last note before we get started with exercise 6. I looked at the grades on the exam, and overall, my overall impression is the grades on this exam were not as good as they were on the first exam. The grades on the first exam were really quite good. I don't know if there's a reason for that. I don't know if people who did really well on the first exam just thought, I got this, and didn't put as much time and effort into preparing for the second exam. I don't know if the material was more difficult. That's usually not the case with that second exam. Chapter 6 is a little bit more difficult, but 4 and 5 are not, so it kind of balances out. If you have any concerns about the second exam, concerns about your grade and where you stand right now, I'd be happy to go through that privately, individually with you. But just a note about how the grade is structured for this course. You all have a copy of the syllabus. If you have misplaced that, the syllabus, of course, is linked here in Brightspace. And you'd be looking for this instructor syllabus. And I was talking with someone in the class just before class about this, but I want to make sure everybody is clear that if you're not happy with your grade on just exam 2, if you thought you were doing well up to that point, or were doing well up to that point, just keep in mind each exam is worth only 10% of your grade. So one exam does not make or break your entire grade for this course. You can see on the screen right now how your grade is composed. So 10% each for all the pre-quizzes, all the exercises, all the problems. There's really no reason not to get full credit on most or all of those, because you have unlimited attempts and you can see your grade. So those really should be gimme points, right? You just have to do the work and stick with it until you get it right. And much of that, and the exercises certainly we do together in class. The problems, I'm happy to help with those outside of class if you get stuck, and some of you have already used that service, I guess. Another 5% for the comprehensive problems, same deal there. As long as you put in the effort, you can see your grade and you can keep working on it until you get a satisfactory grade. So the exams, 5 exams, 10% each. So I just want anyone who's feeling a little bit concerned because maybe your exam 2 grade didn't meet your expectation, maybe was lower than what you got on the first exam, and you're concerned about the impact of that. As long as it's an anomaly, it only happens on exam 2, it's absolutely not the end of the world for you as far as your coming final grade for this course. So hopefully that makes you feel better. If you were concerned, I haven't yet put in the kudos, but just like with the first exam, those of you who did really well on the exam will be seeing kudos from me coming through Starfish. And if I have a concern about your grade overall at this point, you may see a email coming through Starfish related to that as well. So if nobody has any questions, anything else? Oh, and one other thing. So someone asked also before class about whether there will be any additional extra credit. So far you had extra credit as an option in chapter 6. I think if you look at all of the assignments in C now, I think you'll see that there is another extra credit problem or 2 coming up later in the semester. I think there's one for chapter 11, for example. And so if you're really concerned about your grade, I would encourage you to take advantage of those extra credit opportunities. They don't count against you if you don't do them, but so they can only help. Even if you get 1 out of 5 points, that's 1 more point than you would have had if you didn't try it at all. So those extra credits cannot pull your grade down. All they can do is improve it. So let's go ahead to our first exercise for today, and that is related to bank reconciliation. So as we talked last week about internal controls and the obligation of the company to protect the assets of the company, you know, we're talking this semester about publicly traded companies. And one of the issues with publicly traded companies, or any really very large company, is something called, I'm just going to sneak it in here in this white, the principal, that's right, the principal agent problem. The principal agent problem. So this is a concern for all large companies, and in particular for publicly traded companies. The principal agent problem means, in essence, that the people who own the company are not the people running the company. So the principal refers to the people who own the company. In the case of a publicly traded company, that would be the stockholders. The agents are the people, just like a sports agent. The agent is someone who's acting on behalf of the owners, or in case of a sports agent, acting on behalf of the athlete. And so the principal agent problem means that the owners and the managers, the people running the company, are not the same people. And it creates a bit of maybe a conflict of interest in the running of that company. So I think I can make this pretty short. If you are a stockholder in any company, why do you own stock in that company? Why would you buy stock in a company? There's one reason. What's that? Okay, I'm gonna expand on that a little bit. So Patty said dividends, but I'm gonna make it even simpler than that, because not all companies pay dividends. We'll talk about that in chapter 12. But you buy stock in a company because you want to make money, right? You have some money and you want that money to grow for you. You want to use the money you have to increase your investments. Does everyone agree with that? Can you think of any other reason people might buy stock in a company? I mean, you might think about the company you chose for your project. Some of you will have chosen companies because you like the products they sell. But if they weren't making money, if the stock was not a good investment, regardless of how much you like the product they sell, you're probably not buying stock in the company if you don't think it's going to grow in value. And as Patty said, one way it grows is by paying dividends. The other way that an investment grows in value is because the stock price goes up. We call that price appreciation. The stock price goes up. You bought it for 20, it's now worth 25, you made $5. Okay, so the principals, the people who own stock in the company, bought that stock because they wanted to make money for themselves. The agents, the people who work for the company, the CEO, the CFO, all those other officers and top management of the company, why do they work for that company? If you have a job right now, why do you work for the company where you work? God bless you. Make money. For who? Yourself. You get a job, regardless of what your job is, you get a job because you want to make money. You want to get paid. Otherwise, you just do volunteer work, or you hang like if I didn't have a job, I'd just hang out in the woods because that's what I really like to do. But nobody's paying me so far. Nobody's paying me to just hang out in the woods and hike around with my dog. So I have a job. I'm lucky that I like my job, but if they stopped paying me, I would probably not continue to come to work for very long anyway. So the principal agent problem is that there's a separation between the ownership and control of the company. The main duty of the company is to protect the assets of the company, not to enrich themselves, but to enrich the stockholders. That really is the purpose. And so the most vulnerable asset of a company, as we talked about internal controls and having controls in place to protect the assets of the company, the single most vulnerable asset of that company is cash. And so to get back to our first exercise, we need to have a way of making sure that the people running the company are being responsible about protecting the cash of the company as its most vulnerable asset. The second most vulnerable is probably their inventory if they are a merchandising company, if they're selling a product. So in this first exercise, what we are doing is looking at one way that a company can make sure that they're being responsible about protecting the cash of the company. And the way they do that in this exercise is by reconciling on a regular basis. Usually that would mean on a monthly basis. The company is reconciling the cash that their accounting records show is in their cash account and what the bank statement shows. So that's an independent verification. The bank says we have this much. Our records show we have this other amount. It would be extremely unlikely for those two numbers to be exactly the same all the time. There are usually some discrepancies, some differences, not that there are errors, but that there are, in general, timing differences between what shows up on the bank statement and what shows up on our accounting records. What we are going to do in this exercise is see a very simple version of a bank reconciliation. And you can imagine that for a real company, this would get much more involved, much more complicated. And I'll talk about what at least one of those differences and how it would look, just include more detail if this was a real company. So this is not a financial statement. It is a report that the company would prepare, as I said, generally on a monthly basis. This bank reconciliation should be done. Last week, we talked about the importance of the separation of duties. So the person who's preparing the bank reconciliation should probably not be the same person that's writing the checks. There should be a separation between those two duties because it gives you a way of doing a check and balance that the person doing the bank reconciliation doesn't, I don't know, fudge the numbers to make it match, to hide something that they're doing inappropriately, fraud, whatever. And so you can see that we have that 3-line heading. There should be, it's basically the label on this report to let anyone picking it up a month or a year from now know this report was for this specific time period for this company. So you can see it's dated August 31st, 2016. And this would likely cover what happened since the last bank statement. And it would generally be a month, a period of the month. However, the reconciliation, like the balance sheet, is as of a specific date. It doesn't tell us what happened during the month. It doesn't tell us how much they put in and took out of their checking account. That would appear on the bank statement, doesn't appear on the bank reconciliation. It doesn't show us how much they spent or how much they received. It just tells us where are we as of this moment in time. And there are really two parts to this bank reconciliation. I'm going to draw a line right through here. So the top part is, this is what the bank says. And the bottom part is, this is what our records say. And the goal, the end result of the bank reconciliation is that this number, the adjusted bank balance, needs to be exactly the same as the adjusted balance on our company records. So they're not going to start out the same, but we have to identify why they are different. That is the goal, the end result of that bank reconciliation. So we're given some additional information up here at the top, and this is the information we need to be able to prepare this bank reconciliation. Number 1 tells us the cash balance according to the company's records. So we're going to put that down here in the second part below that red line that I put in there. The opening, the balance in the company's records as of August 31st is $32,560. However, according to number 2, the bank statement says we actually have $46,300. So we're off by almost $14,000. Again, that doesn't mean that there are, at this point, it doesn't mean there are any errors. It just means that the information that we have might be different than the information the bank has. We might have some information they don't have yet. They might have some information that we don't have yet. So let's go on to number 3. It tells us the checks outstanding are $28,540. I know you guys probably don't ever write checks. If you're anything like my children, who almost never ever write a check. But businesses certainly write checks. They write checks to pay their suppliers. They write checks to pay their employees. They write checks to pay their taxes, pay their utilities. And that is their record, really their backup for where that money's going, their documentation. And so it is highly likely at any given time that we, the company, have written checks. And when we wrote those checks, we remove that money. We note it as spent in our records, but that whoever we sent that check hasn't yet cashed it. And so we know we've already spent that money, but the bank doesn't know it yet. Again, it doesn't mean there was a mistake made. It just means that we have information the bank doesn't have. And so the next line here is this line correctly. There it is. So one of the adjusting items for the bank is, we know we wrote these checks, they don't know it yet. And so if they knew what we knew, the balance in our bank's account would be $28,540 less. Does that make sense? It's not a mistake, it's just a timing difference. We wrote the checks, they haven't cashed yet. We took them out of our records to show we already spent that money and we recorded the expense, but they haven't cashed those checks yet, whoever we mailed them to. Okay. Number 4 says deposit in transit not recorded by bank. So let's say at the end of the close of business, we gathered up all the money. Let's pretend, I don't know, but let's say we have cash registers. We talked about that as a cash control last week. So we took all the money out of the cash registers. The manager prepared the deposit, but it's after business hours for the bank. And so the deposit just gets put in the safe overnight, and maybe someone's going to take it to the bank tomorrow, or maybe the armored truck is going to come pick it up, however that works for our company. We put it in our records because we made the sales on August 31st, but the bank didn't receive the money maybe until September 1st. That's what we mean by a deposit in transit. We've already processed it, but the bank hasn't received it and added it to our account. Yeah, the rain's making a little squeaky out there. Thank you, Ethan. So it's certainly possible, and maybe even likely, that there's a timing difference in the recording of those deposits. So if the bank knew about this deposit, if they had actually received it on August 31st, they would have added it to our account, but they didn't know yet. It's in our record, it's not in there, so we have to do an entry for that on our bank reconciliation. Now, because we're using these templates, I know that must be everything related to the bank. If this was an actual, real world situation, we wouldn't have exactly the right number of lines already in there. But because I know that's the end of this part, I'm just going to do the math to find the adjusted balance for the bank. $34,135. If they knew about the checks we've already written, if they knew about that deposit that we entered on August 31st, they would know we had $34,135. And now we know that that's the balance we're trying to match on the company's records. So we've gone from being about $14,000 apart to now we're not even $2,000 apart. So we're much closer. And let's see what else we are told here. A check for $180 in payment of an account was erroneously recorded in the check register as $1,800. Typo. Someone just put in an extra 0. So the entry when they recorded that would have been a debit to cash and a credit to accounts receivable. Our customer owed us $180. They paid us $180, but we recorded it as $1,800. It was so now our cash account is too high by $1,620. The difference between what we should have recorded, the 180, and the 1,800 that we actually recorded. And so we need to subtract that. Again, the difference is $1,620. I'm going to put a negative in front of that to remind me to subtract. Doesn't tell us we have to use negatives, so the software will usually accept it either way, but I definitely want to put the negative in there to remind me, hey, that line has to be subtracted. So does that part make sense? That's actually a mistake on our part. And so when we find that mistake, because we're doing this bank reconciliation, it means that we will have to do a correcting entry or entries after the fact. Otherwise, our books will still be wrong. And next month, when we go to do the bank reconciliation, if we haven't fixed that error, it's going to be really, really difficult for us. What else are we told? The bank charged us $45 for service charges. That's what they mean by a debit memo. They took $45 out of our account. God bless you. $45 out of our account to pay for something. I don't know what it was. Something that we agreed with the bank. Hey, you can, maybe we've got new checks. I don't know. Maybe we accepted a couple checks from customers that bounced. And so the bank charged us for that. I don't know what these service charges are for, but what I do know is we don't have them in our records yet. How did we find out about them? Well, they showed up on the bank statement. And so again, after we find that discrepancy, we will need to fix it. It's not enough just to put it here on the bank reconciliation. We then need to get that into our records. The things that we put in the bank part of this reconciliation, they're already in our records. We don't have to do anything with that. The bank eventually will catch up with it. But the parts that we're putting down here in our company's records, these discrepancies need to be fixed. We need to, in this case, put in a correcting entry. And in this case, why does it say add bank service charge? Let me just track. Yep, go ahead.
We have it wrong down there, according to this. It should be deduct service charge, and that should be 45.
So I just put them in the wrong order.
I think so. That's what it's saying.
Okay. Oh, okay, so I must, it's very ambiguously worded. That must be something that we paid out, not something that we received. That's the only way we would be adding it. So we paid someone else and I just misunderstood what that meant. It's not, it doesn't really say who made the payment. I thought we received the payment. But I guess because it says recorded in the check register, I misinterpreted. So this is a check we wrote. Scratch what I said about it earlier. This is a check we wrote, not a check that we received. So I thought it meant someone paid us $180. We actually paid $180 and recorded it as $1,800. So same amount, wrong direction because I misunderstood what that meant. Would have known that in a minute because my math wasn't going to come out, right? I'm supposed to be going up, not down. That makes sense. I can buy that that's what they actually meant is we wrote the check. Okay. And so you just want to check that math. We've now identified, hopefully, all of the differences. Add the 160 to the beginning balance, subtract the 45, and it does indeed match. And so we have a successful bank reconciliation. Our account has balanced. We have identified the differences. Now, one other note before we keep going. Scroll down. One other note, where it says deduct outstanding checks, if this was a real bank reconciliation, you would have a list of all of those checks. Who they, check number, who there was the payee, who was receiving the check, the date, and the dollar amount. And that's very important because we're looking for checks that have gone stale, that is, they're old. Because we then might want to or need to reach out to the recipient of that check to say, hey, we sent you a check 3 months ago, hasn't cashed yet. Did you not receive it? What's going on with that? We just want to stay on top of those checks that have been mailed out or distributed and not cashed. If the balance sheet were prepared for Creative Design Company on August 31st, what amount should be reported for cash? What's the amount that you think we should have on our balance sheet? We've got a few numbers to choose from there. Remember, right now, it says 32,560. Is that the number that should be on there? No, what should be on there? 34,135, because we know that we need to make corrections for those two reconciling items. Error in recording check and the bank service charge. Must a bank reconciliation always balance? What do you think? Yes. Yes, it must. Every company should be doing bank reconciliations. They must be. This is a very important internal control, check and balance on their most vulnerable asset, that being cash. Any questions on that before we keep going? Okay, so this next exercise, remember I told you we now need to, after we do that bank reconciliation, we find those two errors or two omissions, one omission, one error. We need to do journal entries to fix those or correct them or get that information into our records. We've identified on the bank reconciliation, it needs to be there. And so now in this exercise, we're actually going to put those in. In chapter, I think it was chapter 2, but it may have been a later chapter. We did talk about how you fix errors in the trial balance. And we saw that there were two different ways you can do that. There's a 1-step and a 2-step process. This exercise is going to have us do the 1-step process. Just as a reminder, 1 step means we take the original journal entry and we just fix it. The 2-step process is we reverse the original journal entry and then we put in the entry the way it ought to have been from the beginning. So let me put on the screen what the original journal entry would have looked like when we made that payment for that accounts payable that we had. So we would have debited accounts payable 1,800. Remember, it should have been 180, but we had a mistake. And we credit cash because we used cash to pay that bill. Again, the check was only for $180, but the amount we put into our records was 1,800. How could we have avoided that? Well, we could have an automated process of printing the checks. If we print the checks directly from our accounting records, the check would have to match what was in our accounting records because that's where the information came from. In order to have this discrepancy that we wrote the check for 180, but we put 1,800 in our records, that means it's two separate processes. The checks are being written by one system. Maybe they're even being written out by hand, manually. And then there's a separate entry to put it into our records. One way to eliminate that would be to have the information all coming from one system. And so if this is the original entry that we know now should have said 180, but it actually said 1,800. If we were doing the 2-step correction, we would just reverse this entry. We would debit cash for 1,800 to put that back in, and we would credit accounts payable to put the accounts payable back in. Then we would put in the correct entry, a debit to accounts payable of 180 and a credit to cash for the same amount. Based on the way they have the template, we are doing the 1-step process, which is simply correcting the original entry. So cash was actually credited for 1,800. It should have been credited for only 180. We already know the difference is 1,620. And what do we need to do with that? We took too much out of the cash account, so we need to put it back in, right? The exercise tells us to do the entry that increases cash first. And so that's why I'm doing this one first, in case you're wondering. Wanted to point that out. And by the same token, we took $1,800 out of accounts payable. We should have only taken out 180, and so we need to put that other 1620 back in to accounts payable. Increase in that liability also at the same time. We still owe that 1620. The second entry, as we already know from the previous exercise, is to record that bank service charge. So we need to remove $45 from our cash account because the bank already took it out of our actual checking account. And we're going to record that as some kind of expense. So based on the choices we have here, that's going to go into miscellaneous. If we had a very large amount, if we had a material amount of bank service charges, we would not want to lump that into miscellaneous. But if it's $45 a month, we don't need to have a whole separate account for that. And that's it. So critical piece. Not only do we have to identify those differences on the bank reconciliation, we then need to make those corrections or adjustments, get those entries so that the actual amount in our cash account is, in our books, is the $34,135 that we said in the last exercise it needed to be. Questions on any of that? Everybody's good? Let's keep going. Okay. So in the first exercise, we talked about some of the main types of items that you might see on a bank reconciliation. This exercise is another one. It wasn't included on the bank reconciliation we did in exercise 6, but this is something that we could have depending on how we do business. So in the, give me 1 second here. So in the very next chapter that we're going to start on Tuesday, chapter is called receivables, we're going to talk more about notes receivable, but that's what's being discussed in this exercise. So very briefly, a note receivable, the term receivable, we already know from chapter 1, receivable means someone owes us, they're going to pay us later. It's an asset for us. The difference between accounts receivable that we've been talking about since chapter 1 and notes receivable is that a note would include interest. And notes might have terms that are of a longer duration. In other words, we've let someone borrow money from us. Usually it's in payment of an account. So maybe a customer needed an extended time to pay and we said, that's fine. You can take a little bit more time, but we want to be compensated for that since you're not paying us on if we're going to give you an extra 3 months to pay or whatever the time is that we agree to. We also want you to pay some interest on that to compensate us for the use of our money, the opportunity cost that we are taking for letting you hold on to our money a little bit longer. So that's not uncommon. And again, we'll talk about this a little bit more next week, but notes receivable mean that you are owed the principal, the amount that's being borrowed or that credit is being extended, and also interest would accrue on that note. And so when it gets repaid, the borrower or the maker of the note, the borrower is going to pay us the full amount of the principal plus the interest. And that's what happened in this exercise. We had a note with a customer, I'll say, and the customer paid the bank directly for that note. And so how do we know that it was paid? How do we know that the bank put that money into our account? It shows up on the bank reconciliation, or excuse me, it shows up on the bank statement. So we now know that, oh, by the way, they collected on that note for us, the principal that was borrowed plus the interest that had accrued. One last note before we get to this. I said that notes receivable usually have a longer duration or maturity than accounts receivable. We negotiate longer time to pay. And so what that means is sometimes notes might not be due for more than 1 year. Accounts receivable are always going to be a current asset for us based on the definition that we learned in chapter 4. Notes receivable, on the other hand, may be more long-term than that. It may be that they're not due for another 2 years or 3 years. And if that was the case, then that would no longer be a current asset. We would actually consider that an investment. So to our exercise, accompanying a bank statement for Borden Company is a credit memo for $21,200, representing the principal of $20,000 and interest of $1,200 on a note that had been collected by the bank. The company had been notified by the bank at the time of collection, but had made no entry. So we see it show up with the bank statement. We say, ooh, yeah, that money's in our account, but we haven't yet put it into our records. And so that's what we need to do now. So what's one account that you think is going to be affected? Cash. How much more cash do we have now than we had before? How much more cash do we have now than we had before we received this payment? Anyone? 21,200. So the company whoever it was, the customer who owed us money, paid $21,200. Of that amount, $1,200 was the interest, and we haven't recorded that yet. Interest revenue. That interest revenue is going to show up on our income statement for this period. The customer, whoever paid this note, the customer already owed us on our books $20,000. That's the principal or the face value of the note. And so on our accounting records, we were showing the customer owes us $20,000. Now that they paid us, we need to get that note receivable off our balance sheet. They don't owe us that anymore. Now we actually have the cash. Make sense? Any questions? Okay. Moving on then. The next exercise. We are given a bank reconciliation. Looks a little bit more complicated than what we saw in our first exercise today. You can see that in this case, they did list individually all of the outstanding checks. These are checks that have been written, but have not yet been cashed. So we've already taken them out of our records, but the bank doesn't know about them yet. When will they find out? When and if the check actually gets cashed. Looking at this series of check numbers, you can see that this one is pretty far out of the series. That tells me that this is an older check. I don't know how old. As I said, in a real world situation, it would not only say the check number, but it would have the date. It would probably say who the check was written to, although we can easily look that up. But we would want to know the date. Here we are at the end of June, and that check that may be from, I don't know, April. I really don't know. But we'd want to know how old that is. Do we need to start doing some follow-up on that? Do we need to cancel that, put a stop payment on that check and reissue it possibly? But we'd want to check with whoever received or should have received that check before we did anything else. What else do we see on here? So there's the adjusted balance, whoops, for the bank. But what do we notice? It doesn't match the adjusted balance for the company. So is this a good bank reconciliation? Are we going to call this good? No, because those two numbers have to match. And as we said in our answer to one of those questions in exercise 6, every company, every bank reconciliation must balance. So you wouldn't give up on this. What we're told now is that there are some errors. There are some errors in here and we need to find them. So let's go ahead and start. It tells us what to be looking for here. And we have to say whether each of these items is correct, or if not, what it should say. So looking at the heading, we already talked about this line of the heading, that it should be labeled similar to the balance sheet, that it's just a specific date. It's not a period of time because it's that snapshot, just like the balance sheet. So the heading should just say the date. In this case, June 30th, 2017. It tells us right there, that's the date that should be on there. But it shouldn't say for the month ended. The next thing we're supposed to look at is the outstanding checks. These outstanding checks, these are checks that we have written and we took them out of our bank, our balance and their accounting records, but the bank still has them in there. So what's wrong with what's listed here? What's wrong with the way they presented it? Sorry. Yeah, so it says we should add those. No, the problem is they're still in there and they need to be deducted. So for the second one, they should be deducted from the balance per bank statement, not added. They're still included in this balance, but we've already written those checks, they just haven't cashed. The next item is the deposit of June 30th. This says deduct deposit of June 30th, 6,600. What's wrong with that? Should be added. We've already added it to our records. The bank doesn't know about it yet. It's called the deposit in transit. How about the service charges? Here we have service charges. Should be deducted. The bank took that out of our account. And we haven't done the journal entry yet to remove it from our records. So we still need to do that journal entry. How about the error in the June 17th deposit? So the deposit should have been $71.50, but there was a typo and it was recorded as $17.50. We didn't put enough into our account, right? On our records. So the bank correctly added $71.50 to our account. We only recorded it as $17.50 on our end. Should that be deducted? No, we didn't put enough in. We want to add that. So it should be added to the balance per company records. And then finally, the adjusted balance per the bank right here. So we can tell that one of the problem is that it doesn't match. I don't know without using my calculator what number that should be, but we know that they need to match. So the problem is that the adjusted balance per bank does not equal the adjusted balance per the company. So now with those corrections, we need to prepare a corrected bank reconciliation. And I'm going to ask you to do this on your own. But right now, we have time to do this during class. I'm going to pause the recording and ask you to prepare this on your own. And hopefully, when you have finished, your adjusted balances for the bank and the company will match. And that will be one way that you'll know that you've done it correctly. Obviously, you have the check my work button as well. So go ahead and pause the recording. Prepare your bank reconciliation, and when you're ready to move on, restart the recording. Okay, so now you've had a chance to do the bank reconciliation, and you should have found that the adjusted balance on the bank statement for the bank and for the company now match, and the total should be $19,780. Okay, and with that, aren't any questions, we'll move on to exercise 10. We have one more exercise after this. We're going to be jumping back to exercise 1. Remember, I told you last class I didn't put them in the right order when I put the set together back in August. So let's move on to exercise 10, which is a bit of a different topic than what we've looked at in the previous 4 exercises. So the bank reconciliation all deals with the major portion of our cash that isn't actually sitting around the business in dollars and change, but instead is deposited with a bank in a checking account. We call that cash because it is usable funds that we have access to. We can write a check to use that money. One of the other topics in this chapter is the idea of cash equivalents. So I want to spend just a moment talking about that. If you look at your the company that you chose for your annual report project this semester, it is highly likely, almost a certainty, that the very top line on their balance sheet does not just say cash, as we've been using starting in chapter 1. Instead, it probably says cash and cash equivalents, because probably 99.9% of companies, very close to 100% of companies, use that term. And that includes the cash that they have on hand, for their cash registers. It also would include the cash that they have deposited in a checking account. That's what, in economic terms, if you've taken or are going to take macroeconomics, you'll hear the term checkable deposits. Those are part of M1, which is one definition of the money supply. Those of you who are in the AS Business Administration program, that is the one that's designed to get you ready to transfer on. Are you required to take macroeconomics, and banking in the money system is part of that class. So what I'm talking about now, you'll hear again in that class. So it includes cash, it includes those checkable deposits. It also would include any short-term investments. So something that is short-term, something that is considered a cash equivalent. In order to be considered a cash equivalent, what that tells us is it's not cash, but it might as well be. Couple of criteria, couple of requirements. In order to be considered a cash equivalent, it has to be relatively risk-free. So in other words, it can't be an investment in stock or bonds of a company, because there is some risk that the value, and if you watch the stock market at all, right now in 2022, it's a huge risk. So the market has taken an extreme hit so far this year. So, a stock investment, although yes, you could sell that stock and have that cash available to meet your liquidity needs, you have a risk that it won't be worth as much as it was when you put the money in, when you bought those shares. Same thing is true for corporate bonds. As interest rates are rising right now, there's been, what, 3 interest rate hikes in the last couple months here. So that means that interest rates across the board are going to be rising or are rising. And so bonds, we'll talk about bonds more in chapter 11, but bonds have an inverse relationship with interest rates. What that means is if interest rates are rising as they are right now, that bond prices are falling. So there's an inverse relationship. You couldn't invest in corporate bonds and consider that relatively risk-free because the prices are subject to fluctuation based on changing interest rates. So it has to be relatively risk-free to be considered a cash equivalent. That means it needs to be maybe a CD, a money market in the bank that is guaranteed, it's protected by the FDIC insurance or whatever. Or it could be an investment in government bonds, as long as requirement number 2, relatively short duration. And that would be less than 3 months. Less than 3 months. So if you are buying putting the money into a certificate of deposit, the duration, the maturity length of that CD has to be less than 3 months from now. In other words, we're preparing a balance sheet right now. We know we're going to prepare another one 3 months from now because we prepare them quarterly. That's every 3 months. So if we're preparing one now, in order to be considered short duration, it has to turn back into cash by the time we do our next balance sheet for the next quarter. So a cash equivalent, like I said, could be a CD, it could be a government bond, as long as the duration is less than 3 months, those are considered relatively risk-free. So it doesn't actually have to be coins and bills that we have physically with us on, at the company. Could be deposits in the bank. It doesn't even have to just be in our checking account. It could be in our, if we have a savings account, or if we have CDs, as long as they have a short duration. If they have a longer duration than that, they're considered investments, not current assets, not part of cash. Everybody okay with that definition of cash equivalents? Okay, so why did I bring this up on this exercise? Because what we're talking about in this exercise is also considered a cash, well, it actually is cash, but it's not sitting in our cash registers at our company or at our store. It's not in our checking account. It's not one of those cash equivalents. It's a separate concept. And this is the petty cash fund. Now, the term petty cash, if you've ever taken French, you probably already know that word petty, but in French it's spelled like that, P-E-T-I-T, but it's pronounced the same way, petty. If you see literature, accounting records from maybe even 50 years ago, it probably would have been written P-E-T-I-T for petty cash, but we have kind of Americanized or anglicized the term, and so it's now petty cash, P-E-T-T-Y. So what does petty mean in French? Does anyone know? Anyone take French? I'll give you a hint. In French, the feminine form of that word is petite. You know what petite means? Small, right? Short. So a petty cash fund means it's a small cash fund. How a company defines small depends on the size of the company. And so in this case, we're told that the company's establishing a petty cash fund of $500. Another company might have $5,000 in their petty cash fund because of their particular needs and the relative size of their company. So there's no dollar amount that automatically makes it petty cash or not petty cash. But what it means is it's a relatively small amount compared to the size of the company, but it's enough to meet the needs of the company. The idea of a petty cash fund is we have a small amount of cash physically on hand at our business so that if small cash needs arise, we don't have to write a check for it. So it's easier to handle those small transactions. So it needs to be a small enough amount that it's not material in the overall scope of the organization. When you establish a petty cash fund, our internal control processes must require that there is one person who is the petty cash custodian. That one person is the only person who should have access to the location where that money is stored. So maybe it's in a strong box, in a locked drawer, in a locked office or something like that. So it shouldn't be in a place that everyone can just get into it, because then there's no accountability. There's no internal control to prevent misuse of those funds, theft of those funds. There's an entire set of internal control procedures related to that petty cash fund. I already mentioned one person should have access to it. So when anyone needs money from that petty cash fund, what they should be doing is going to the petty cash custodian and having permission to get money, a certain amount of money from that fund. If they're being reimbursed for something that they paid maybe out of pocket, they need to have receipts for that. That's the documentation or the proof that they actually spent that money. And then, and only then, would the petty cash custodian distribute money, documenting that, writing up a receipt. Probably it's good practice to have the person who paid out the cash, the petty cash custodian, sign that. And also the person who received the cash should sign that receipt so that you have that documented record. That's part of the separation of control, the separation of duties, to make sure the petty cash custodian should not be paying him or herself out of that fund. So let's see what's happening in this exercise. Check number 12-375 is issued to establish a petty cash fund of $500. And so at that point, what we would do is move $500 out of the regular cash account and into the petty cash account. Now, as I just described cash and cash equivalents, we know that you're not going to see on a balance sheet a separate line for the petty cash fund. It's going to be lumped together with that cash and cash equivalents. So you're never going to see on a summary balance sheet, you're never going to see a separate line that just says petty cash. And that's fine, because by definition, that's going to be a relatively small amount, immaterial compared to the overall scheme of the company. And so now throughout the period, throughout maybe the month, the people, the employees are accessing through the petty cash custodian and with receipts. Hope there should be receipts, there should be accountability for the money that comes out of that fund. There should be a way of knowing where that money was spent and how it should be recorded. And so let's say at the end of the month, again, the company is going to establish a policy. How often does that petty cash fund get replenished? The policy might be when it reaches a certain level. So this fund started with $500 in it. It might be that the rule is once it gets down to 100, we replenish it. It might be that we do that on a monthly basis so that our accounting records are up to date. But again, this is a small amount of money by definition. And so we're not as concerned about making sure that this gets recorded at the end of the month. So it's up to the company to make that determination. How often does this get replenished? Is it because it reaches a certain dollar amount, or is it because it's the end of the month? So at the end of the period, when we're going to replenish this account, Letter B says the amount of cash in the petty cash fund is now $40. So we have spent, or at least it's missing from the fund, $460. It started with 500. We wrote a check for that $500. The petty cash custodian may have taken that check to the bank, cashed it, gotten small bills and change so that they can make change out of the box, out of the, wherever it's secured. Ideally, in a perfect world, each time money is taken out of that box, a receipt is put in the box for the amount that was removed from the box. And so in a perfect world, at the end of the period, when we go to replenish this fund, we should have receipts totaling $460 because that's how much is missing out of the box. But we talked last class, we heard that, if you're working a cash register in, say, a grocery store or some other retail operation like that, it's not going to be 100% of the time that your cash register has to the penny exactly how much it should have. And that's what we see here. So if you were to add up all of those receipts, we have office supplies for $212, miscellaneous selling expense $156, miscellaneous administrative expense for $61. If we add all of those up, it does not equal $460. We still need to request a check for $460. And so that's going to be part of this entry, is the issuance of a check for $460. And that's going to restore the petty cash fund to its full $500 amount. We are going to report that we purchased $212 of office supplies, that we incurred some miscellaneous selling and administrative expense, $156 and $61. I'm going to say that those dollar amounts are big enough that I would hope that these are summary, that someone didn't take $212 out of the $500 in petty cash and go to Staples and buy $212 worth of office supplies all at once. Even though it might be a small number in the grand scheme of things, it still seems like it's a pretty big number for someone to be walking around with that in cash. I would prefer to think this is more of a, we ran out of something, someone goes to Staples to grab a couple things and maybe it happens more than once. So that's a summary of what was spent. Now, so how close are we? We know that the journal entry has to balance. That is, the total dollars that we debit must be equal to the total dollars that we credit. How far off are we? Anyone have a calculator? How far off are we with this entry?
71.
I think it's 31. I think it's 31. So we need $31 more debited. Did I add that right? Someone else said 31, right? Okay, thank you. So we need to have a debit of $31 to make this balance, because we know we need $460 put into the petty cash account. So this $31, where did that come from? I don't know, because there wasn't a receipt in the box. Are we concerned about that $31? Well, only if it's two things, one of two things. If it's a material amount, if it's a large enough amount that it matters, and usually our rule for that is if it's more than 5% of the total, then we'd be concerned, hey, what happened to that money? And who's responsible for that? The petty cash custodian. Hey, Joe, there should be $31 more in the account or in the box. Where'd it go? But it may be just that someone, the receipt got lost. I don't know. If we don't think if it's not a material amount, and the other criterion, if we don't think it's an attempt to defraud the company, If we think someone stole that money, it doesn't matter how much it is, it's a problem. We're concerned about that. But if we don't think it's part of an attempt to defraud the company and we don't think it's a material amount, we're not too worried about it. We may, have a talk with the petty cash custodian about, you need to keep better track of this. We need to make sure, as I mentioned at the beginning, that money is accounted for, that only the petty cash custodian has access to it, that it's locked up and secured. But what are we going to call that? Because we can't have a debit of $31 without having an account that we're debiting. If we are a company that uses cash registers, we would probably just add it to that cash short and over account. We talked about that account last week, that's kind of the catch-all account to make the cash register reporting balance. We can only debit cash for the cash that was actually in the register, but we have a sales report from the register that says what revenue needs to be recorded, and we use that cash short and over to reconcile that. If we use a cash short and over account for other purposes, we can just throw it in there. I would suggest if we don't use it already for some other purpose, we would not want to use it for this one purpose, and we would just call it miscellaneous. And so that is how we would use the petty cash fund. Notice that when we set up the petty cash fund, we put the $500 in there in our accounting records in journal entry A in this exercise. But as we replenish that account, we don't actually change anything. The petty cash fund account is not part of entry B when we replenish it. We put the $500 in there and it just stays there. It will continue to show $500 at all times, unless we either decide to increase the amount or get rid of petty cash. Any questions about the use of petty cash funds? Everybody's good? Okay. So let me go back to exercise 1 and let me share this. And this is our final exercise for this chapter. So as we have done in a couple other chapters, starting in chapter 4, when we looked at current ratio and working capital, we've looked at inventory turnover, days inventory on hand in chapter 6, the last chapter. And now we're looking at chapter 7. How do we use this information to help us maybe make some decisions about this company? What kind of information that we just learned in this chapter is going to help us with that decision-making process? And in exercise 1, what we're going to be calculating is a concept known as days cash on hand. So we mentioned in an earlier chapter that all businesses have 2 main goals. Liquidity, having enough money to pay their bills. So liquidity is how close, a measure of how close things are to being cash. And the other goal was profitability, that is making money, right? That we have a positive net income that's enough sufficient return on investment to attract and hold investors, stockholders. And so this exercise or this calculation speaks to that liquidity question. How long can we survive? How long can we continue to pay our bills with the cash we already have? Or another way of saying that is, when would we run out of cash if we don't get any more in? And you can see there the calculation for days cash on hand is cash and short-term investments. And I actually already just talked about what we mean by a short-term investment. So something, although it's not exactly the same as cash equivalents, don't get me wrong, but short-term investments are things that are going to turn back into cash within 1 year. And so we assume that those are available to spend to pay our bills, to keep us afloat. And then we divide that by our daily cash operating expenses. So we want to make sure as a business that we have enough cash to pay our bills, but as we talked about in an earlier chapter, we don't want to be sitting on so much cash that we're not being good stewards of the investment capital that we have. Having cash sitting in the bank, especially in a period of rising inflation, is not a good practice for our business. So it's a balancing act of having the right amount of cash, that we have enough money to pay our bills, but we don't have so much cash sitting around that we're not getting a good return on investment for our shareholders. Okay, so let's go ahead to our exercise. Oh, let me, before we get there, in the middle of this slide is the calculation for daily cash operating expenses. Not all of our operating expenses are in cash. We talked about depreciation in chapter 3. We'll talk about that more in depth in chapter 9, but depreciation is not a cash expense. It's not something we pay. And so a simple way of getting at our daily cash expenditures is to take our operating expenses, but subtract out depreciation since that's not cash. There are some other expenses that are also not cash. We'll talk about those more in chapter 13 at the end of the semester when we talk about the cash flow statement. But from what we've learned so far, depreciation expense is the one item that we're going to subtract. And then we know the total amount we're spending on cash operating expenses. If we divide by 365 days, that'll tell us how much we need on average per day. Okay, it's an average, doesn't mean every day we spend that amount. Some days it's going to be more, some days it's going to be less. But on average, that will be how much we spend. And let's go to our final exercise. Hopefully you made a note of those calculations. So the numerator of the equation is going to be our cash operating expenses. Whoops. I said that backwards. Let me just put the formula on the screen for you. Expand that a little bit. So our numerator is going to be our cash plus short-term investments. And then the denominator is going to be our daily cash operating expenses. Okay. So let's, for 2018, let's find our daily cash operating expenses. So we take our total operating expenses for 2018. You'll notice, by the way, that it gives us 2 years of data there, 2019, 2018. The more recent year is listed to the left because that's the first you encounter. We read from left to right, so that's the first you encounter. I just wanted you to see that because that is the standard format for accounting information presentation, that the older years are going to be farther out to the right. So they're in, I guess, reverse chronological order. So we take our our total operating expenses, we subtract from that the depreciation because that is not a cash expense. And then we divide by 365 to make it the average per day. Where do we get that information? From the income statement. We can see their operating expenses on the income statement. And then we just need to divide by 365, round all calculations to one decimal place. So 143.5 per day on average. How much did they have for cash and short-term investments? In 2018, they had 24,250 in cash and 9,460. So those are investments that we have available to spend. They're short-term in nature. We no longer have a chapter about investments, but I'll just throw out there that some investments that are short-term are based on management's plan, stated intentions for those. So short-term investments can include stocks and bonds. Even though I already told you they can't be considered cash equivalents, they can be considered short-term investments if the company says, we have these available, we can sell the stock or we can sell the bonds if we need cash to run our business. And so when I divide the 24,250 plus 9460 by $143.50, I got 234.9 days, almost 235 days worth of cash and short-term investments on hand. That seems like a pretty good number. I do not have for you an exact number that's good enough, that rule of thumb that we talked about. And so for this company to do this comparison, is that good? Well, good compared to what? We need to do the calculation for 2019 and see how, is it better or worse? So go ahead and do that calculation for 2019. This will be the end of our class for today. We have about 2 minutes left. Anyone get a number for that one? 262.8. So assuming that that's the correct number, and I didn't do the calculation, I was busy writing it on the screen. So are they more liquid or less liquid in 2019? More. They have more days cash on hand. Is that too many days? Maybe. That's like 9 months worth of operating expenses on hand. That might be a little too much. And so we might look at that and say they should do something else with some of that cash because they're not using it wisely to create an investment return for their shareholders. I don't know if that's too high or not, but we can say it is more, it's increasing. And this company is going to have to decide if it's too much or not. Part of that's based on the economy, what kind of situation the economy's in, how risky or uncertain, how volatile is the market right now. Thank you for being here, and I will see you next Tuesday.